We now begin the second part of our course, Financing Decisions. We cover 4 topics in this introductory session: financing math and net present value, financing and investment decisions compared, financial market efficiency, and 6 lessons in market efficiency. Let's start by introducing the math of the financing decision. Financing math, similar to investing math, involves determining value by discounting future cash flows. Let's take the example of determining the value of a guaranteed student loan, which is a subsidized loan. With a guaranteed student loan, the government facilitates your borrowing of, let's say, $100,000 at below market rates to finance your master's degree. In the example, the term of the loan is 10 years. The interest rate is 3% with annual interest payments, and the repayment is on maturity. That is, there's no amortization of the loan principal. So what is the value of the loan subsidy if the alternative or market interest rate is 10%? To determine the value of the subsidized loan, we calculate the net present value, which in this case is determined by taking the amount borrowed in time 0, determining the present value of interest payments out over the 10 years of the term of the loan, and determining the present value of the loan repayment at year 10. I've started a new Excel file for the examples we'll develop in this second part of the course. The first sheet is entitled Guaranteed Student Loan. In the upper left corner, I've put the particulars of the loan: a principal of $100,000, a term of 10 years, an interest rate of 3%, and an alternative interest rate of 10%, which we'll use as our discount rate. Note that I've already done the work necessary to calculate the net present value of the loan. Now I'm going to erase these cells in the spreadsheet to show how to set up a loan or financing evaluation. In column C, we want to indicate the years of the loan term. So I'll just type in 0 and 1 for the first 2 years, highlight those 2 cells, put the cursor on the southeast corner, and drag down to year 10. In column D, we want to indicate the cash flows associated with this loan. In year 0, the student gets the principal of the loan, or the amount borrowed. In year 1, the student pays interest only on the outstanding principal. So let's set up an equation for the interest in year 1. It's going to be equal to the loan principal. I'm going to lock that cell reference times the interest rate. I'm going to lock that cell reference, and we have our first year interest expense. Now I want to go back up to the formula bar and modify the equation for the interest expense by inserting a negative sign, because the interest expense, or the interest payment, is a cash outflow in year 1. Now because we've locked our cell references and we have interest-only expense in each of the 10 years of the loan, we can simply drag that formula down for years 2 through 10. The final component of the cash flows for the guaranteed student loan is the lump sum repayment of the principal in year 10. So let's put our cursor on the cash flows for year 10, that is in cell D13, go up to the formula bar and modify our existing formula by subtracting the principal that has to be repaid in year 10. So now we have a negative cash flow in year 10 of $103,000. Now to calculate the value of the stream of cash flows, or the value of this guaranteed student loan, we need to calculate the net present value. So let's just put a label there, and in this cell we're going to go up and invoke the NPV function. The arguments are first the discount rate, and we're going to use 10%, which is the interest rate we would pay on our best loan alternative, which is a market rate loan of 10%. The values are the cash flows in years 1 through 10. Then we say OK, and we've calculated a present value. Then we need to go up, as usual, to our formula bar and modify the calculation to add in the year 0 cash flow. Our result is a net present value of about $43,000. Therefore, the value of a guaranteed student loan to the student is about $43,000. Or another interpretation is having access to the guaranteed student loan program increases the student's wealth by $43,000. The reason the loan program increases the student's wealth is because the loan program makes a 3% interest rate available to the student to finance his or her education, instead of a 10% interest rate that the student would have to pay in the regular financial markets. Note that to evaluate a financing option, we use the discounted cash flow approach and the net present value calculation, just as we did in evaluating investment options. Note further that the stream of cash flows in a financing option is essentially opposite the stream of cash flows in an investment or capital expenditure decision analysis. That is, in a financing decision analysis, we start with a positive cash inflow in year 0, and in years 1 through 10, or throughout the term of the financing, we typically have negative cash flows. And that's just the opposite of what we saw in a capital expenditure analysis, where in year 0 we had a negative cash flow, and years 1 through the term of the project we typically had positive cash flows. Let's compare financing and investment decisions in some more detail. While the investment decisions we've been discussing determine the asset structure of the firm as represented by the left side of the balance sheet, financing decisions involve optimizing the right side of the balance sheet, or selecting the best mix and types of debt and equity to finance the firm's operations and assets. The financing or capital markets in developed countries are perhaps the best examples of competitive or efficient markets that exist. Recall from economics the characteristics of competitive markets. They are homogeneous product, lots of buyers and sellers, open information, and no imperfections in the form of taxes, etc. These characteristics pertain to financial markets pretty well. The homogeneous product is money. There are lots of buyers, that is borrowers, and lots of sellers or lenders of money. And there is fairly open information. An important public policy is to protect the openness and fairness of information in financial markets. Hence, it is considered appropriate to make an example of famous violators, such as Martha Stewart, by throwing them into jail. However, there are certain market imperfections that apply to financial markets, and we'll discuss these imperfections throughout this part of the course. Now, contrast the characteristics of financial markets with those of markets involved in the capital expenditure decision. In capital expenditure decision markets, there's typically no homogeneous product. An office building constructed to the specifications of one firm will not suit perfectly the needs of another firm. And a manufacturing plant is even more specialized. Capital expenditure markets are also characterized by specialized knowledge rather than open information. Firms guard their production processes and strategic plans, which they properly consider competitive assets. For these reasons, financing decisions are usually easier to make than capital expenditure decisions. Because of near-perfect markets, it is difficult to make or lose a lot of money in financing decisions. In the extreme, in perfect capital markets, financing transactions are zero NPV transactions because there is always an alternative financing opportunity of the same cost. In contrast, it is easy to lose a lot of money on a bad capital expenditure, such as setting up a manufacturing plant in the wrong way, at the wrong time, or in the wrong place. And it is surely possible to make a lot of money with a wise capital expenditure. Finally, if a firm or an individual makes a financing decision that turns out not to have been optimal, the decision can typically be reversed at little cost. A common example is refinancing a home loan. A borrower with a home loan at a high rate or with unfavorable terms can pay off that loan before maturity, either by refinancing at a lower rate or using his or her cash reserves, thereby substituting equity or debt. But unfavorable capital expenditure decisions are much more difficult and costly to reverse. For example, if you build a retail shop and no one shows up to buy clothes, the market for your new asset is pretty thin, and you may have to unload it at a big loss and at the cost of lots of valuable time. So in making good financing decisions, we often look for market inefficiencies. These inefficiencies create opportunities to make money. Put another way, the existence of these inefficiencies often point the way to good versus bad financing methods or approaches. Financing market inefficiencies can take many forms. Information asymmetry can occur where, for example, borrowers know more than lenders. Transactions costs exist, wherein maybe it costs 1 to 3% to mount a public offering of stock. Obviously, there are taxes. In particular, we're interested in the different tax treatment of different financing options. And finally, there are other subsidies, such as low-interest loans to students, to take into account. The existence of financial market inefficiencies often point the way to optimal financial or financing decisions. Before moving to financing decision analysis, which will involve careful evaluation of market inefficiencies, let's consider the implications of financial market efficiency for financing decisions. We start with the random walk theory, which says that the movement of stock prices from day to day do not reflect any pattern. Statistically speaking, the movement of stock prices is random and skewed positive over the long term. As we have learned, the positive skew has produced a positive return on investment in stocks over the long run. But in the short run, you can't predict movements in stock prices based on previous stock price movements. Here's the proof of the random walk theory. This is a scatter plot of returns on a portfolio of stocks in week T across the x-axis and week T plus 1 on the y-axis. Note there is very little correlation between returns in one week and returns in the next. So again, in the short run, past performance does not predict future performance. As noted earlier, financial market efficiency depends importantly on open information. If everybody knows equally what has happened, market prices reflect history. This view of markets reflects the weak form efficiency hypothesis. Here, people with better knowledge of the present and future prospects of a firm, based on careful research using publicly available data, can make money. Remember the importance of the growth rate, or G, in the stock valuation formula. But if markets already reflect all public information, maybe because there are lots of stock analysts looking at this information and giving and selling advice, or maybe because institutional investors dominate the market for the stock and they are careful to account for all public information, then the semi-strong form efficiency hypothesis applies. In this case, you can only make money if you have special or private information. Finally, if market prices reflect private information as well, then we have the strong form efficiency hypothesis. In this case, nobody can make money on a regular basis buying and selling a particular stock. People's views of the opportunities to make money in the stock market depend a lot on whether they believe in the weak form efficiency hypothesis, the semi-strong form efficiency hypothesis, or the strong form efficiency hypothesis. The text lists 6 lessons of market efficiency that summarize the effects of these financial market efficiency notions. Lesson 1. Markets have no memory. The weak form efficiency market hypothesis says past price changes give no information about future price changes. Lesson 2. Trust market prices. Market prices reflect all information. To do better than the market, you have to know more than other market participants, and it is unlikely that you do. Lesson 3. Read the entrails. Market prices of stock and market interest rates on bonds provide valuable information for decision makers, as long as decision makers pay close attention to them. Lesson 4. There are no financial illusions. Markets see beyond accounting presentations to the substance of a firm's performance and prospects. Lesson 5. The do-it-yourself alternative. Investors will not pay firms to do what they can do themselves more cheaply. Investors can diversify their holdings by themselves. They don't need the firm to diversify for them, unless the firm can do it more cheaply or to special advantage. And Lesson 6, see one stock, you've seen them all. To investors, stocks are near perfect substitutes. They all present a mix of risk and return. The investor cares only about risk and return and not the particular aspects of particular stocks. Note that these lessons pertain to efficient financial markets. That is not to say that they apply perfectly at all times. Consider the notorious example of Enron. How did so many people lose so much money on Enron stock? Maybe investors use past growth as a predictor of future growth, ignoring Lesson 1. Importantly, it has been argued that investors did not read Enron's financial statements closely, thereby violating Lesson 3. If they had, they would have been able to predict the firm's demise.